Hey, everybody, welcome back to the podcast. It's June 17th, 2025, and today was a wild ride in the world of finance, the economy, politics, market, and trading. Wall Street took a hit as escalating tensions between Israel and Iran rattled investors, oil spiked, and the shadow of the US China trade talk continues to loom large. From a surprising Trump smartphone launch to corporate moves shaking up stocks, we've got a lot to unpack. Whether you're an investor, trader, or just trying to keep up with the headlines, I'm here to break it down clearly, thoughtfully, and with the energy you need to stay in the know. So grab your coffee, maybe something stronger, and let's dive into what happened today. Here's a snapshot. Markets slid across the board today. The S&P 500 dropped by 80 bips. The Nasdaq fell by 90 bips, and the Dow Jones was down by 70 bips. Oil prices surged to a 5-month high, driven by the Middle East and tensions that we've been seeing there, and political moves like President Trump's early exit from the G7 summit added fuel to the fire. We'll dive into the details, look into what is driving these moves, and what it means for your money. Let's get to it. Let's start with the markets because today was all about risk-off sentiment. The S&P 500 fell nearly 1%. The Nasdaq dropped by 90 bips, and the Dow slipped by 70 bips. That's a rough day, and it wasn't just Wall Street. Global markets felt the heat too. So, what's behind the sell-off? There are two big forces: geopolitical tensions in the Middle East and political curveballs tied to U.S. leadership. First, the Middle East. The Israel and Iran conflict escalated today, with fighting entering its fifth day. Israel launched airstrikes from Iranian targets, and Iran responded with retaliatory strikes. President Trump upped the ante, calling for Iran's unconditional surrender and even urging Tehran's evacuation. Pretty intense rhetoric. That sent oil prices soaring. West Texas Intermediate crude settled at 75 a barrel, up 4.3%, its highest since January. Now, check this out. Oil is climbing fast, but it isn't just about supply chain risks. The Strait of Hormuz, the choke point for about 20% of global oil, could be disrupted if this conflict widens. That's a nightmare for markets, raising costs for everything from gas to shipping. Energy stocks like Exxon and Chevron still took a hit, down about 1.5%, as investors were worried about broader economic fallout like inflation creeping back up. And then there's politics. Trump left the G7 summit early today, stirring up uncertainty. Posts on X captured the mood. Investors are skittish, and his comments on Iran didn't help. Add that to ongoing U.S. China trade talks, which hit a snag after Trump hinted on Truth Social that China needs to step up for a deal. And that's a blow to the optimism we saw earlier this week about tariff cuts and rare earth access. The result, market leaned defensive with traders selling off riskier assets. Now, breaking down the sectors, energy was a mixed bag. Oil prices jumped, but energy stocks like Occidental Petroleum fell by 1.8% as fears of economic slowdown outweigh supply concerns. Tech took a beating. Nvidia and Broadcom dropped, with the sector down 1.2% overall, partly due to Taiwan's tightened export controls on China's Huawei and SMIC. Financials held up a bit better, only down by 30 bips, as some bet on a flight to safety. Consumer discretionary stocks, though, they did get hammered. Think retail and travel. They were down about 1.5% as oil prices threatened to hurt spending power. So, what is the takeaway? If you're in a growth or tech, today's dip might sting, but it's not time to panic. Geopolitical shocks create volatility, and that can mean opportunities if you're patient. So, if you're in energy, oil's rally could lift some names, but broader risks are weighing heavy. Cash heavy investors, keep an eye out. Sell offs like this can create buying opportunities. Now, let's pivot into the economy because it's setting the stage for what's coming next. The Federal Reserve kicked off its 2-day meeting today, and investors are on edge waiting for Wednesday's decision. The backdrop: inflation's at 2.4% year over year for May, close to the Fed's 2% target, but new data today added some wrinkles. Here's the deal: retail sales, housing starts, and an industrial output came in softer than expected today. Retail sales grew by 0.2% in May, but forecasts had 40 bips. Housing starts dropped by 3%, oof, and industrial production today barely budged. That's a sign the economy is cooling, which could push the Fed towards rate cuts. But with oil spiking, some worry inflation could creep up, making the Fed cautious. The Fed's expected to hold rates at 4.25% to 4.5% tomorrow, according to CME FedWatch data. But the real focus is on uh, fair market valuations, and more importantly, Chairman Powell's press conference and the Fed's new dot plot. And that's their forecast for future rates. If they signal one or two cuts in 2025, markets could rally. If they sound hawkish, citing oil or trade risks, we might see some more selling. Interest rates are the backbone of the economy. Higher rates raise borrowing costs, think mortgages, car loans, business expansion. Lower rates spark spending and investing. In 2020, near zero rates fueled a stock market boom. If you remember the meme stock mania, that's part of the reason why that happened. If the Fed leads dovish tomorrow, we could see a bounce, but the Fed is worried about oil driven inflation. Growth stocks could stay under pressure. So if you're in stocks, a dovish Fed could lift your portfolio. Cheaper money boosts valuations. If you're in bonds or saving money, rate cuts might trim your returns. And if you're eyeing a big purchase like a home, lower rates could mean better loans soon. Tomorrow's a big day, so make sure you watch that closely. Now, let's talk politics because it's driving markets as much as economics today. President Trump's early exit from the G7 summit sent ripples through global markets. Posts on X were buzzing about it. Some call it a sign of U.S. unpredictability. His comments urging Iran to surrender or evacuate Tehran didn't spike oil. They raised fears about deeper U.S. involvement in the Middle East, which could drag markets down further. Then there's the U.S. China trade saga. After progress earlier this week on tariff cuts, Trump's latest post suggests that a deal is not a slam dunk. That's the problem. Markets have been banking on lower tariffs to ease supply chain costs and boot tech and manufacturing. If talks stall, we could see more volatility, especially in semiconductors and consumer goods sectors. Now, politics isn't just headlines, it's money. Trump's moves are amplifying uncertainty, and that's why investors pulled back today. But there is a flip side. Clarity on trade or geopolitics could spark a quick rebound. It's a high stake game. So let's zoom into the stocks making some noise today. It's a mix of big wins, sharp losses, and one of these head scratchers that we see all the time. Here's the rundown. So first, the wild card. The Trump Organization announced Trump Mobile, a $499 US made smartphone with a $47.45 monthly plan, including 5G, roadside assistance, and telehealth. I feel like an infomercial. It's a bold leap into the cutthroat market dominated by Apple and Samsung. The made in the US pitch might resonate with some, but its really breaking that market takes serious capital and execution. No stock to track since it's a private company, but it's definitely a story to watch. Now, speaking of meme stocks, GameStop took a brutal hit today, dropping by 25% after raising $1.75 billion in the stock offering. Post on X flagged it as a dilution concern. More shares mean less value per share. It's a reminder that meme stock can be a wild ride, especially with volatility like this. On the flip side, Oracle surged by 24% after a stellar Q4 earnings report. Cloud growth and AI demand are fueling its rally, bucking the tech sector's broader dip. If you're in tech, Oracle's a bright spot today for sure. JetBlue slid by 3% after announcing cost cuts and flight reductions, a sign for tough times in travel. Enphase Energy, a solar inverter maker, crashed by 17% pre-market after demand concerns. Higher oil prices make it so that renewables are less attractive in the short term, and investors are feeling it. U.S. Steel kept climbing after Trump approved its acquisition by Nippon Steel, a win for shareholders despite the broader market drop. Kering, a luxury good giant behind Gucci, also gained after naming Renault CEO as its new chief. Leadership changes can definitely spark optimism, but luxury has been continuing to be resilient. Now, markets are a global story, so let's take a quick tour. In Europe, it was a rough day. The London's FTSE 100 fell by 50 bips. Germany's DAX dropped by 40 bips, and France's CAC 40 slid by 30 bips. Israel-Iran conflict and Trump's G7 exit weighed heavy. Asia was no better. Japan's Nikkei 225 fell by 50 bips. The China Shanghai Composite dropped by 80 bips, and India's Nifty 50 dropped by 35 bips. With pharma and healthcare hit the hardest, Sun Pharma was down by just about 2%. Trade uncertainty and oil prices dragged sentiment down. Crypto, though, held its ground. We're seeing a bit of a downturn later in the evening. A lot more to come, at least throughout the remainder of this week. Geopolitical uncertainty affects all asset classes in different ways, and Bitcoin and other altcoins are not enough unaffected by that. So, what's on the horizon? I think we have three big things coming up. You have the Fed's decision tomorrow. A dovish nod could spark a recovery. A hawkish stance might deepen the sell off. You have continued Middle Eastern tensions. If oil prices keep rising, inflation fears could dominate. And then you have trade talks. A US China trade deal could lift markets. A breakdown could hit tech and manufacturing hard. My take, markets are shaky but not in free fall. Volatility is high. The VIX, it's Wall Street's fear gauge, hit a 3-year peak today, but that could just mean opportunities for the patient. So for you, it's really about staying strategic. As a certified financial planner professional, it's one of the things that I advise to all of my clients. You need to stay in the market for a longer period of time as opposed to trying to time the market. So don't bet all your cash on one sector. Keep some cash ready. Dips like today might be buying moments, and make sure you focus on the long game. Headlines pass, but a solid plan endures. And that's a wrap for June 17th of 2025, a day of market jitters, geopolitical drama, and big stock stories. I hope this helped you cut through the noise and see what's really moving the needle. So, guys, what is your read? Time to buy the dip or stay cautious? Drop it in the comments. I'm always reading. If this was helpful, make sure to hit subscribe and the bell for tomorrow's breakdown. And until then, stay sharp and keep investing. I'll talk to you later. Bye.